Hello and welcome to The Rules of Investing, the podcast that gets inside the minds of leading investors, economists and industry experts, brought to you by Livewire Markets. My name is Chris Conway. Today I'm speaking with Scott Helfstein, who is the head of investment strategy at Global X ETFs. The use of ETFs has grown rapidly in recent years, and there are now more than 2 million Australians using them in their investment mix. Last year, Aussie investors collectively pumped around $25 billion into ETFs, and there is now almost $200 billion invested. Today, I'll be speaking with Scott about his unique background, his interest in thematic investing, and some of the big opportunities that he sees in markets today. If you're an Apple Podcast or Spotify user, don't forget to subscribe so you don't miss out on any episodes. If you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to the leading investment minds in the country. And with that, Scott, welcome to The Rules of Investing. It's great to have you.
Thanks for having me.
Scott, my research tells me that you spent some time at the Combating Terrorism Centre at West Point, and you are also a senior fellow at the Centre for Cyber and Homeland Security at Auburn University, a fairly unique background for an investment professional. Can you please tell our audience a little bit about the experiences you have had in those roles and whether there is any crossover with your investment philosophy?
Sure. So my route through the industry and through government has been a bit of a windy road. So I studied finance as an undergraduate in university and worked at the Federal Reserve Board and then became an investment banker for a few years at Credit Suisse First Boston, at which point I decided to sort of step away a little bit from finance and do a master's degree. I thought a year off would be good, a master's degree in war studies over in London in King's College. So that was the beginning of that track, which then brought me to a PhD in public policy and political science in Michigan, and then over to West Point, where I was on faculty as professor of social science, and then teaching economics, international politics, and then counterterrorism issues. So my appointment was joint with the Army's Combating Terrorism Center, and so that is how I wound up in that role. The military academy at West Point is really a special place. The cadets are fantastic, great energy, really interested in going out in the world and doing good. And so, being able to support them in the classroom, being able to support them, as thesis advisor and some of the other activities. The other part was as research director for the Combating Terrorism Center for most of my time there, and interesting organization where it's actually set up as a nonprofit in the U.S., and so there is both private donation and public support. So we would work with a number of offices on a contract basis. So everything from the Office of the Secretary of Defense for Policy to the Special Operations Community. I can say that because it's been written up in a book by a couple New York Times reporters. So, everything that I am saying here is
been cleared,
as we say, is above board.
Yep.
But really got to see what the operational community was like up close through that experience. At major facilities like Fort Bragg and MacDill Air Force Base, which is where Special Operations Command runs out of. Great people working really hard, and a set of experiences, some of which I won't quite cover. A set of experiences that I think changed, right? Certainly were informative, but everything from being able to work with the Department of Defense on their data architecture. This predates Palantir by quite a bit, but essentially helping them think through how they combine, integrate, and make use of their vast resources across different databases on issues like terrorism and insurgency, to projects on network theory to support prioritization for what operational forces would do. Got to teach at essentially advanced war college classes on radicalization and the behavioral aspects of political violence.
Mm-hmm.
So a whole lot of really interesting experiences. The crossover, when I actually left that and came back to be the deputy to the chief strategist at BNY Mellon Investment Management, the crossover is around prioritization. So fundamentally, if you're trying to pick investments, let's say you're a manager of the S&P 500, you've got constrained resources or finite resources that you want to allocate to the places where it will do the best good. And in this case, in the investment world, it's the best return. Well, there's a very similar problem when you're looking at terrorism, insurgency, intelligence, right, military activities. You've got a finite resource pool, and you're trying to figure out how to prioritize against different threats. So it's really about resource allocation at its very core. So that is the overlap. And I think for me, the general interest that cuts across is really in the behavioral economics sphere and understanding how, psychological biases, how we form beliefs, how they change over time. And for the record, it's true for assets. Why does NVIDIA sell off 13% over 3 days after being up 140, right? There is a behavioral aspect to investing, just as there is a whole series of behavioral challenges that come up in the counterterrorism space. So I think those are probably the two areas that most link up.
Scott, are you familiar with Jocko Willink? We're just going off on a tangent here. Yeah, I read one of his books, and one of the big premises that he talks about is to prioritize and then execute, especially on the battlefield. So really interesting to hear those comments that ring true in that same sense. Scott, we're in an election year in the US and in many other countries around the world. I think it's 50% of the democratic world is voting this year. What's your take on the state of geopolitics more broadly, particularly relationships between the US and countries like China?
Can I crawl under the table now?
Yes.
So my preface here is I am optimistic about the economy. I am optimistic about markets. I think there are a lot of good things around innovation, efficiency, even in areas like labor. There's a lot to be excited about. Geopolitics is definitely one of the bigger challenges, and I think it's actually the source of probably higher volatility in the second half of the year.
Right.
So we've went through from, call it 2021, 2022, we went through a couple years where most of the market vol was driven by monetary policy concerns, right? The phrase people started tossing around MPV, monetary policy volatility. And so when we got inflation readings, when we had Fed meetings, that tended to, draw hedging, which is ultimately what's going to lift, for example, something like the VIX index based on, put-call ratios. So we've now just lived through a period where volatility has been very, very low in markets. I think, by the way, that probably coincides with the fact we started the year with 7 rate cut expectation for 7 cuts. That's now down to 1 to 2, and yet the markets are still up. So I think what the markets are kind of saying is we don't care as much about monetary policy as we did. The media might still care about it a lot, but markets seem to be kind of ignoring it. And I think that that's what sets the stage, because volatility will probably be not quite this subdued. I mean, you look internationally, it's the first time the U.S. is probably facing conflicts in 4 different theaters simultaneously that are all core to its national interests since at least the end of the Cold War, and arguably you would say since 1973, because we've got a really difficult environment with China. So relations are probably at a modern low point, and I don't think the prospects for improvement are great. We've got the Ukraine conflict going on, Central Europe, So obviously core, on top of an attempt to reestablish failed deterrence, right? Russia chose to invade, so deterrence didn't work. And, compellence, as we say, so forcing somebody to stop doing something as opposed to getting them to do something in the first place. Compellence is harder, and unfortunately the Ukrainians are living through. The Middle East is obviously a challenge. And, potential escalation from Hezbollah in the north of Israel on top of whatever is going on with Iran's support of Hamas. And then more recently, I shouldn't say more recently, but quieter, is Venezuela seizing some territorial space from Guyana that gives them a potential, illegal I suspect, but a potential claim. I am not a lawyer. There's a caveat. But will probably drive them to lay claim to offshore oil rigs that are privately owned by major U.S. companies.
Right.
So, we can talk more about the details of what's going on down there in terms of Russia is getting involved. Iranian fast boats turned up in Venezuela. Maduro, was really nice. He put it right on Twitter and advertised the fact that his shipment had come in. It's like when your kid gets like the new Pokemon cards and wants to put it on the Snapchat to all their friends. So we've got a whole series of international challenges, and then obviously we have the U.S. election kind of squarely in the middle. So we do think that geopolitical volatility is an area for investors to be careful about. That said, there are some areas or some investment options that people can consider.
Scott, just very briefly, given your expert opinion across the entire global landscape, any views on Australia and where we fit into the mix? We are a small country, of course, but I think economically still reasonably significant.
So Australia's been a very staunch ally to the United States. We obviously have the peace treaty. Recently, I think there's been kind of I don't know if it's conscious or unconscious decision to keep your head down and play a little bit of a smaller role, partially because you are stuck in between two worlds.
Yeah.
Your economy is contingent on taking chunks of the continent and selling it on China, selling it to China in a very significant way. Meanwhile, people might disagree, but I would say politically, ideologically aligned with traditional U.S. values. And so that's a really tight rope to walk, and that has gotten even tighter over the past couple years. So arguably going back to 2016. So I love being in Australia. There's opportunities, I think, to modernize sectors of your economy around materials, in particular, with automation technologies, and we all need to get more efficient on the financials, side of the book. I would think that some of the deglobalization that's going on, right, and people looking to limit or reduce their exposure to China, right, is creating opportunities in other industries, other places in the world. So I think that there'll be an opportunity to diversify more, but none of that addresses the core issue around just stuck in the middle.
Scott, let's change gears a little bit now. You were the head of thematic portfolio management at Morgan Stanley, and now you're head of investment strategy at Global X ETFs. What is the appeal of thematic investing?
Well, as I like to say, it breaks the style box.
Right.
So, traditionally we think about value growth, we think about size, we also think about sector investing. Sectors is really one of my kind of sticking points, because you've got airlines that, for example, are in the industrial sector, and you have hotels that are in the consumer discretionary sector. And do you know what we learned during COVID? Those things are highly correlated.
Yep.
If people don't get on planes, they don't stay in hotels. And yet, we invest in the consumer segments at different times of the economic cycle that we would invest in the industrial segments.
Mm-hmm.
So, all of that, whether you're talking about value growth, whether you're talking about cap size, whether you're talking about sector, it's all backward looking. It's all historical constructs of either what your past performance or characteristic was as a company, not your future, or it is a categorization, sectors, for example, based on an economy that arguably doesn't exist anymore or is fundamentally changed. The advantage you get with thematics is that you can, in your head, try and develop a vision for what the economy will look like in the future, and then reverse engineer and say, what are the new industries and what are the segments that are going to get us there? And so I'm not stuck just buying a categorization that's 50 years old. I can buy something that I think is going to drive us.
Scott, you've provided a nice segue there. You've talked previously about the concept of where the puck is going. Now, I must very quickly ask you, Game 7 of the NHL Finals, who do you think wins?
As it turns out, the owner of the Panthers is a friend of mine.
Wow, okay.
And was a West Point graduate and staunch supporter of the Combating Terrorism Center. So
go Panthers then.
I have got to go with the Panthers, and I wish them the very best of luck. They've worked really hard to, as all teams do, but they've worked really hard to get to this spot. So good on them.
Excellent. Thank you. A very quick segue there. We'll get back to this concept of where the puck is going. And this is, as you were alluding to in that previous answer, effectively being in a theme before it happens rather than chasing it. It seems like thematic ETFs often do follow trends rather than lead them. So, is it possible, and how do you get ahead of these trends? And can you give us some examples?
Yeah, that is tricky. Part of the reason why, in a lot of cases, it lags. Two reasons. Number one, you're always kind of framing around investment opportunities around one of two things. It's either performance or valuation. So either something is cheap and you think that there's opportunity. I love to frame things around valuation, but the investing community loves to invest based on past performance. Mm-hmm. And by the way, that is a behavioral economics issue right there. Running into a burning building is really, really hard. Matter of fact, in November of 2022, I wrote a piece for Global X that, remember, everybody's bearish on the economy.
Yep.
Really bearish, and companies. And I wrote a piece called Entry Points in Burning Buildings, because everybody hears from clients, oh, I think that's an interesting idea, but I want a better entry point. Well, November of 2022, when everybody is negative, that's your entry point. But when you're down 20% or 30%, the last thing you want to do is allocate more, right? That's that whole loss aversion thing that people experience. And this goes back to Kahneman, Tversky, prospect theory. So the reason why a lot of investors jump late onto trends is because that's what our brain is hardwired to do. We see the positive performance and we say, oh, now we want to get into that. For fund issuers, it's a little bit more complicated because you have to build these things.
Yep.
And so you got to go through selection process. You got to identify what your rules and your methodology are. What do you want to include in a theme? What do you not? How do you then set it up to be able to get what it is you want out of it? And you've got to go through a government filing process, and you're going to get comments. And so, in the United States, the standard filing is 90 days. So even if you can build something, which some of us in the industry have in a couple weeks, and get the paperwork in, you're still not going to have something out till probably, 4 months, potentially longer down the line, depending on the complexity of it. And then you've got to list it on the exchange and find your ticker. So there's a lot of pieces that go in. So if it's the hot topic of the moment, oftentimes it won't work out. Look, and a great example of that, in the United States, we actually closed down our metaverse fund. Mm-hmm. But if you go back to 2020, COVID's on. What's the topic that everybody's talking about, right? Money is moving into anything called metaverse.
Billions and billions, yeah.
And so, I was on a team that was following suit, and there was one product, kind of a second, that was in the marketplace, and 4 or 5 products all launched at the same time. Most of them did not get assets. A couple of them that did actually performed for a little while and ultimately sold off because, look, fun on a base level, for Web 3.0 to really succeed, it's got to kill Web 2.0. And Web 2.0's had 20 years to actually interact with us. And for us to determine that we like it, it's useful. I step out of the door here and I need to, there's no cabs outside and I need to get somewhere else downtown. I can pop on my phone and it's right there. So identifying trends on the early side is a little hard, right? There's a saying in our business, early is wrong, late is wrong. If you don't have it right then and there. But to Global X's credit, predates me. They launched our AI fund in 2018.
Right.
And that now, as of about a week and a half ago, crossed $2 billion in the U.S. There is a Australian version of it, GXAI, that is here. And so it's a newer fund, and it's about 90 companies. And what it does is it caps mega cap tech at 3%. So every 6 months it gets reset. So you're less concentrated than an S&P 500 tech sector. You're less concentrated than an NASDAQ 100. You're spreading it around to more players, right? I view it as it's not one company or 2 companies, NVIDIA or Microsoft, that are going to dominate. It's an ecosystem of hardware, software, data. So it is possible to identify the trends ahead of time. You're not going to get them all right. But that was one, and I actually wrote my first piece about it at Morgan Stanley in 2017. My top hardware pick, which hardware was the first area we told people to focus on. The top pick was NVIDIA back in 2017. So sometimes you can get them right.
Yeah.
But there are other areas that I've thought, could potentially take off that, quite frankly, investor interest is tough to capture.
Scott, I spoke to your colleague here in Australia, Billy Leung, recently about GXAI, and he was talking about the same thing about the 3% limits that you mentioned, and also having access to the entire opportunity set across the entire AI stack, which I thought was a really novel and interesting way of looking at the opportunity. Scott, for those who are unfamiliar, what is the difference between sector and thematic investing? You talked a little bit about sector investing before, but what's the difference as you see it between the two?
So sector investing is a little bit of a cottage industry on Wall Street, because it's what the big firms actually hire their equity strategists to do. And so there are basically 10 sectors, and they're spread out across these categories like consumer discretionary, consumer staples, information technology, industrials, materials, financials, utilities, healthcare, energy, and I think I'm pretty close to REITs. So, and so there are these categories that essentially are supposed to tie back to how you generate your revenue. They're then broken down into industries and sub-industries. So ultimately, a company gets put into a sub-industry that graduates it up to being in a sector. So for example, the S&P 500 technology sector, right, should have information technology companies that are providing many of the things that are relevant to AI. Whether it's, companies like Adobe or, or Workday, Intuit, all of which that are playing in the AI space. But there's also technology companies that are not going to have anything to do with AI. So, for example, Cisco, right? They make routers, they make technology hardware, right? Intel, for right now, isn't really, right? They made a decision, rightly or wrongly, that they were not really going to play in the AI sector, or segment. So you get companies that, based on historically what their business model was, they get allocated into a sector. Whereas with themes, we're not just given that construct, right, that framework, we get to go and build it. We get to say, well, look, we want AI, so there's stuff that we don't want. What do we want, right? Who's making the investments? What types of software are most likely to roll it out? What parts of hardware are going to be really important to the development of the technology? And then we get to target into those areas. So an example that I like to toss out there is cybersecurity, where here we've got a fund called Bug, BUGG. I'm a big believer, as you would imagine, in AI, really more broadly, the automation and digitalization revolution driving the economy. And let's face it, right? The more we do of that, the bigger the risk profile, right, or vector. If we're going to trust AI with more and more information, well, we better protect the algorithm that's giving us answers. We also, by the way, better protect the data that it's training on and it's using to make those inferences. So we're putting more and more stuff and more power into the virtual space. We need to defend it. Cybersecurity is a part of the software sub-industry. So if you want to invest on a sector basis, you either can invest in software, but you're going to get Adobe for your visual software, right? You're going to get, as I mentioned, like your Workday for your HR app. You're going to get things that are not cybersecurity. And certainly in technology as a whole, that's even more companies. Versus, if you say, I just want cybersecurity, well, there's a fund of 24, 25 companies that, there's no historical cybersecurity sub-industry, but we can identify who is playing in that space and put that together as a basket.
The role of thematic investing in a portfolio, Scott, how do you see it in today's environment?
So for a long time, I think thematic folks used to talk about cord satellite. I kind of struggle with that issue because you're taking something away from the core to put into your satellite. And if we're going to be honest, for most investors, it's a growth equity allocation. So rather than invest in a NASDAQ 100, let's say, I scratch my head about this. I think we're all a little bit confused. I mean, you've got like Costco and Pepsi in the NASDAQ 100. So these are not necessarily small, innovative companies. These are the largest 100 companies that happen to be listed on NASDAQ at any given time. Rather than do that, we can pick 4 or 5 different themes like AI, like cybersecurity. We can talk about, for example, copper and wiring up data centers. We could look at uranium for how we're going to power the AI revolution. And so right there, you've got 4 themes that, other than cyber security and AI, which might have a little bit of overlap at any given time, you're going to be pretty distinct. And you're getting a basket that isn't just taking the largest 100 companies, whether you like them or not. You're focusing on things that are going to be critically important to the economy. So we're seeing increasingly investors use themes as a replacement for either passive indexes or actively managed growth, because they want to play a bigger role in determining where their exposures are across themes.
Do you envisage one day, Scott, people's portfolios having nothing but ETFs in them? Is that the end game?
ETFs are a tool. There's lots of different flavors out there. I encourage people all the time to understand what you own, actually look under the hood, look at the methodology, look at the holdings, because you can listen to somebody talk and feel like you're ideologically aligned with their version of the future, but be utterly uncomfortable with their risk management techniques, for example.
Right.
And so first step is, I think, knowing what you own. The ETF is a really nice wrapper, and it's a great wrapper for thematics and for growth-oriented investing, because you're taking on a basket. You're not trying to pick the 1 or 2 winners. Like, there are some people in the world that are great at being able to say, these are the 2 stocks in cybersecurity that I want. or these are the two stocks in genomics that I want. But for a lot of us, a basket alternative that, is tied to market cap, so the better a company does, right, the more it's worth, the more it's going to be represented in the ETF. So I don't know that it's a matter of supplanting. I think it's a matter of providing tools. And there are, models that people run and advisors and investment houses that are 100% ETF models. And that's what they're billed as, and that's how they're managed.
Scott, I'm going to hit you with a few themes. Can you please rank them based on the size of the opportunity? So really, where do you expect to see the most growth? The themes are EVs, battery tech. That's one theme. AI, robotics, and cybersecurity. So 4 themes there. Which ones do you think have the biggest growth potential?
I'm not sure if this is more a question about my preferences or more of a test of my memory. To be honest
let's go with your preferences. Yeah.
I think AI is probably the biggest.
Mm-hmm.
There's something in the neighborhood of various estimates, 10 to 20. I mean, call it one of them that we published is 16 trillion of global cost savings and revenue enhancements by 2030. If we just get a fraction of that, by the way, profit margins would be even higher than they already are, and they're already for the S&P 500 at records, right, for the last 13 quarters, above 12%. So I think AI probably has to be number one. I think cybersecurity for me is number 2. So it was EV, cyber, and
robotics was the other one. Yep.
I'd probably say robotics is number 2.
Okay.
You look at demographic trends. The U.S., Europe, Japan, China, only the 4 largest economies in the world, all have aging workforces.
Yep.
So in the United States alone, by 2040, we'll have something like an 18 million worker shortfall. So if you just look at the current level of productivity, and then you look at the number of active workers to total population, right, or working age to total population, we need more efficiency and across all of those economies. Otherwise, we have to take a cut in our quality of life. I don't think we really want to do that.
No, wouldn't be too many people signing up for that, I wouldn't have thought.
So we really, and there are areas that are surprising where, for example, if you look at per 1,000 workers, the U.S. is deeply underpenetrated in robotics, right? Japan is pretty high. South Korea is pretty high. So there are some economies that have embraced it quicker. There's a lot of work to be done. So I think for secular reasons. You also, by the way, look at the onshoring theme that the United States is doing with high-tech production. And that's another example of something. We don't make 14 nanometer chips by hand. We need more robots. So I would say AI, robotics, cybersecurity, which we've already discussed. I would probably put EV and lithium towards the bottom of that list. I think it's a really interesting contrarian play right now because it hasn't worked that great in the market. So if you were to reframe the question and you were to say, out of those, which is the contrarian, it is the EV and the lithium. But I think the expectations ran a little hot after 2022. The U.S. and Europe pushed really hard for public policy that would and really soft power influence over the automakers to increase EV production, and the consumer just hasn't materialized in the way that they hoped they would. So we will most likely sell more electric vehicles next year in the U.S. than we ever have, and the year after, and the year after that. But the growth trajectory, I believe, in those markets isn't quite as robust as we thought it was going to be 2 years ago.
Scott, is there a segment or theme that you think is flying under the radar right now?
Well, there usually are. I do think uranium is actually one that we should be talking about more. And so I referenced it earlier.
Powering the data centers, yeah?
Yeah, the energy, the electricity needs, we're already, according to the International Energy Agency, in the next decade going to increase like our electricity needs by 20%. And that was something along those lines. And that was before we really started thinking about the data center build out that's going to go on. We need to power these things. Japan is already talking about putting their nuclear facilities back online. Germany, which made a deal with the Greens a decade ago that was really about renewables, but also contingent on cheap natural gas from Russia. That hasn't panned out.
Yep.
And, even here in Australia, I've turned on the TV a couple times and seen news interviews debating the merits of the nuclear build-out. In the U.S., we're not going to build huge facilities. It's going to be small modular reactors, which the good news is we've been floating them around on submarines for 60 years, hundreds of feet underwater. We know how to do this.
Yep, that's right.
So I would say that's one that a lot of investors aren't paying attention to. I can't claim to be brilliant on this. I mean, it was a story that caught my eye a couple months ago. Amazon Web Services spending $650 million for a data center next to a nuclear power plant. And I don't know what it's like in Australia, but it's not like people are grappling for 2-acre properties next door to nuclear power plants to build their dream home. So, I mean, for me, that was just sort of the realization. And then when you look into it and you consider the fact that, these SMRs are going to be commercially available over the next months, if not, the year or two. So in a pretty short order. Doesn't take a long time to get them online. So that's one that I think investors should be watching.
Scott, just zooming out a little bit and broadly about ETFs now, what do investors need to know about thematic ETFs in terms of risks? What can go wrong, if anything?
Well, that gets a little bit back to knowing what's under the hood.
Right. And
knowing what the methodology is. So there certainly are instances where, you have ETFs that are actively managed. So you certainly want to understand track record, manager preferences, and something like that. In a passive ETF, you want to understand what the rules are. You want to understand what the risk profile of the fund is. There's, for example, in the US, there's now single stock levered funds, right? And that's levered ETFs. That's not the business that Global X is in.
Sure.
We provide, pure play access to themes across multiple companies, right? And so there's diversification, right? We weight based on usually a modified market cap. So like in AIQ, we cap, what your max exposure is going to be, but you should understand what those caps are, right? You could end up with an over-concentration in something that doesn't have a cap. That's a straight market weighting. So there are different ways things can go wrong, and then we can be early to a theme. We can be late to a theme. And we can have themes that develop in ways we don't understand. And so that's, just about paying attention to the news, identifying the signposts to try and figure out when things are moving in the direction we expect or when they're shifting.
Scott, we're getting towards the end of the conversation. It's been very insightful so far, so thank you for that. There's 3 questions that we always ask our guests, and the first one is, can you share a story from a big investing win or loss? So what happened, what went wrong, or what went right, and what was the lesson that you learned from it?
We all have those. I mentioned that I'd really liked NVIDIA in 2017. I actually didn't buy it. I had my mother buy it.
Yep.
I bought AMD instead, so I thought
still not too bad.
Diversifying, not so bad.
Yep.
But that was one where, on one level, I can say it was a tremendous win. I still think I'm her favorite child, just for now. My brother's an internet analyst, so I probably shouldn't say that too loud. He might hear me from Australia. So that was sort of a win, and yet, I said to myself, I'm going to diversify rather than over concentrate, and so there's a little bit of a loss baked in there too.
Does Mum still hold NVIDIA?
She does. She sold a little bit in 2022 just because, well, you got to rebalance at some point.
Yep. No wonder you're still the favourite son. Makes perfect sense. Scott, next one. What do you think investors are getting wrong about markets right now across the entire landscape?
Number one, I think we're paying way too much attention to interest rates.
Mm-hmm.
Like if the economy is growing at 5.4%, from 2001 to 2019, we averaged 4% nominal growth in the U.S. In the 18 years prior, 80s and 90s, we averaged 6.4. If we can grow at 5.4%, I don't care about rates. Rates are a short-term vehicle to try to encourage growth. If you're growing, you're agnostic to what the rates are. So I think we're focusing way too much on that. And as a byproduct, I think that we are, I think that investors are still modestly underweight risk assets.
Mm-hmm.
And you want to participate in what's going on right now. You don't want to be sitting on the sidelines, in the U.S. in particular, people with cash and money markets. And I get, like, we just lived through a turbulent time, but the economy is looking a whole lot more like mid-cycle expansion than late cycle. So
get off the sidelines.
Yeah.
Last one, Scott, and it's a juicy one. If you had to buy only one thematic ETF and hold it for the next 5 years, what would it be and why?
I think it's I'm going to give two quick answers. I think it's the AIQ or the GXAI here in Australia, partially because there's a valuation story. Price to 2025 earnings for the S&P 500 is 19. That GXAI, is at about 19 and a half.
Mm-hmm.
So you're basically getting what is the most dynamic segment of the economy that really offers the opportunity for true transformation, and you're getting it at more or less the price you're paying for the S&P. I mean, that to me just screams opportunity. The other one that I love is there's a partner fund here called PAVE. They both have the same ticker in the U.S. and here. That one's convenient, which is U.S. infrastructure development. And this is not traditional asset owner annuity type infrastructure. This is not the Brookfields of the world that own the port and that are going to pay you an annuity. These are the people that build it in the first place.
Right.
It's one of the only funds that's really like it. And focusing on the U.S., infrastructure is one of the only issues that's going to be bipartisan in the election. It's the Democrats' primary win for the last number of years, right, for this administration. Republicans are going to say they wanted it first in the prior administration. We've already got $1.2 trillion of spend underway in the IIJA, the infrastructure, $600 billion in the CHIPS Act, $300 public, $300 matching private. That's an infrastructure bill because you got to build the facilities. That's what the money's for. It's not for operating them. And who builds them? The same people that builds your roads, your bridges, your ports, construction, heavy equipment, materials. So that's one. And the valuation on it is still really quite attractive relative to the broader market. So,
Scott, thank you so much for sitting down with Livewire. Fantastic insights. We appreciate you spending the time.
Thank you for having me.
If you enjoyed that podcast but haven't yet subscribed, you know what to do. Hit the subscribe button now. And don't forget to check in at Livewire Markets. We're adding lots of fresh content every single week.